In today's masterclass, we're going to talk about top-down analysis for beginners. It's going to be a really simple masterclass, but really packed with value. So this right here can actually help you become a trader with a high win rate. By the end of this class, you will know how to look at the market from the big picture, from the higher time frame down to the smaller time frame, so you can find the best trade setup. Before actually going deep into it, we need to understand what is top-down analysis. Well, it's simply when you start with the big picture, looking at the monthly time frame or the weekly chart, then zoom into a smaller time frame such as the daily, the 4 hour, the 1 hour, to just plan and execute your trade. I'm sure we all familiar with Google Maps. I think most people use Google Maps. By using a Google Maps analogy, for example, on the zoom out view, which is here will be our time frame, higher time frame on the chart, you see the main highway of the overall direction you need to go. Right? Well, let's say you go to your car and you open your navigation app, Google Maps. When you zoom out, you will see the main highway, the overall direction where you need to go. Then if you zoom in closely, you probably find the best trade or turn to reach your exact spot. So you see the pathway more clearer as you zoom on your phone to see the path. That's pretty much the same with the price action as well. Now, let's talk about why use top-down analysis. Why is it important for us traders to use top-down analysis? Because when you think about it, it's just some extra step you have to take your trade. And if we have to take additional steps to take our trade, it needs to be worth it. So let's talk about why you use top-down analysis in the first place. The first and really important about top-down analysis is when you use top-down analysis, it actually helps you, the trader, to trade with the trend instead of against it. The second reason why it's worth it to use top-down analysis, because it makes it easier to spot your key support and resistance in your chart. Those are important level that you probably use to find your entry and exit. And the third reason why you should use top-down analysis is because it will actually help you build your confidence. By using top-down analysis, you get more confidence in your trade setup and you end up having a high win rate. Now, let's talk about some of the benefits of consistent top-down analysis. The first one is improved trade selection. So by just using top-down analysis, you end up trading better setup. And because when you use top-down analysis, you end up using the higher time frame. By just trading with a trend on the higher time frame, you will naturally filter low probability trade. Because top-down analysis requires you to start from the higher time frame trend, you end up taking less trade that go against the trend, and therefore taking the best setup you can find. Another benefit of top-down analysis is having a better risk management, because identifying major support and resistance level helps you place more effective stop losses and take profit. And we know when we use top-down analysis, we're going to actually find our major support and resistance level on the higher time frame as well. The third benefit that I have here for top-down analysis is increased patience. We know as traders, we tend to be super impatient and we tend to enter trade too quickly sometimes before the setup is ready. By understanding the bigger picture, that will help you wait for high quality setup rather than forcing trade. So this right here, we also help with other trading as well, because you learn how to be patient on waiting for the bigger picture to match your setup. The last benefit I have here for consistent top-down analysis is trading psychology. And it's simple. Having a systematic approach reduces emotional decision-making and build confidence in your analysis. Because you see, by following a top-down analysis framework, you're going to have a systematic approach to find your setup. And by just doing that, you reduce your emotional decision, and that also improves your confidence in your analysis, because you will see so much insight on different time frames that align with your analysis in the first place. And that will increase your confidence. Now let's go about the different steps of top-down analysis. So this one is going to be a simple version, just to actually give you a rundown about how it looks like. Step one, choose the high-end time frame. All right, so we start on the high-end time frame. You can either use the weekly or the daily. So I have that example. So here on the higher time frame, what I want to do here is to identify the overall trend. I want to know the major trend. And here when we talk about trend, it's all about the direction of the stock. And after identifying our overall trend, we also need to mark our major support and resistance on that higher time frame as well. Those zones or key levels will be super important. Those are the main levels we need to watch. Step two, we go to our medium time frame. So it can be the 4 hour or the 1 hour as example. And on that medium time frame, we pretty much look for market structure, or higher highs or higher lows. Or you can also look for pattern if you love to trade patterns like channel, range, triangles in general. I love to trade price action, so I usually focus on market structure. You're free to use whatever strategy you like to use. This right here is not about strategy. It's about a framework to go on how to find the best setup based on time frame. Step 3, now we go to the low end time frame. And that can be the 15-minute or the 5-minute to find the entry. So on the low end time frame, you're pretty much waiting for your entry signal. It can be candlestick pattern, breakout, retest, whatever strategy you like to use. Again, this is not a strategy session. It's just a framework regarding top-down analysis. So what you do here, after waiting for your entry signal, because that will be your entry trigger, what you look at that thing you're looking for your entry. So all you have to do is to make sure they actually match with the bigger trend. For example, if you actually have a bullish candlestick pattern, but your overall time trend, for example, is bearish, then it doesn't match. So that means you shouldn't take that trade because it doesn't match. You always want to actually have your lower time frame entry match the bigger picture trend. Let's have a simple example really quick. So let's say you go to the chart. On the weekly chart, the market is in an uptrend, so we're pretty much moving to the upside. Now you go down, and this is your high time frame. And now on the daily time frame, which is your medium time frame, MTF, price is pretty much pulling back at support. So that's where you pretty much observing market structure. On the 1 hour time frame, that's where you pretty much look for your entry signal. So here in the example, you see a bullish candlestick pattern at support, and that's where you probably decide, okay, do I want to actually look for the entry? But here, guess what? Bullish candlestick pattern at support also match the overall, weekly trend, the bigger picture in the uptrend. So this right here is going to be a match. So we have a bullish candlestick pattern at support. We also have the uptrend on the higher time frame. And in terms of market structure, we're pretty much near support as well. So all those 3 major time frames pretty much align for entry. So what do? So we enter on the long side, so on the bullish side, and we can actually have a stop below our support on the daily time frame, whatever level we have at that support level, we can actually set our stop below that and target on the next resistance level on either the medium time frame or higher time frame. So again, it all depends on the type of trade you're trying to take. So if you're trying to take a scalp or day trade, the time frame will be different, or it's going to be what you choose for. And here we're pretty much talking about the big picture of this top-down analysis, just the concept of it, you can understand it. Of course, from trade to trade, it's going to differ, because if I'm a swing trader, so I'm going to focus on even higher time frame, but it's still the same process. For on the other swing trader, there's something at higher time frame, medium time frame, and smaller time frame. For a scalper, even though they're only catching the small move, in that same category of trading style, you also have a higher time frame, a medium time frame, a smaller time frame on that trading style. So each trading style will have different type of time frame. Now let's go over the common mistake most beginner traders make. One of the first one is when I'm jumping straight into the 5-minute time frame. You pretty much come to the chart and just like while they're waiting to find a trade, you have no idea about what's going on in the bigger picture. You're so focused and zoom in that smaller time frame, you have no idea about the flow of the market, so you're pretty much going to be lost. The second common mistake that beginners make is ignoring the bigger trend. Trading against the major trend is like swimming against a strong current. You're pretty much trading against the flow of the market. It makes it really, really hard to succeed. It's more easier to swim in the direction of the current or the flow of the market. So if you're a beginner, that's why you need to focus. That's what you need to focus on, and that's why using the top-down analysis is really important, because from the first step of the top-down analysis is to actually find the major trend, and all you have to do when you find the major trend is to try to trade with the major trend and not against the major trend, because trading against the major trend is much harder to succeed. The third one is trading against major support or resistance zone. On the chart, there are areas where price has historically reversed, so trading against them reduces your probability of success. And this right here, that's why it's really important when you use the top-down analysis to mark your major support resistance zone on a higher time frame, because those key levels are usually history level where price went there and strongly respected those levels. So when you have those levels on your chart, your main goal is to trade with those levels. You shouldn't be trading against it, because if you do, you're definitely reducing your probability of success. And you don't want that. You want to actually trade and end up having a high win rate. So if you want a quick exercise to actually practice, right, you can actually go on TradingView, open the chart, and actually choose any stock and try to actually have 3 different time frame, right? So again, we have high time frame. Let me actually use this. So we have 3 different time frame you need to go to, right? Your high time frame, your medium time frame, and your smaller time frame, which is pretty much like H, M, HMS. So this is the HMS time frame, high, medium, small time frame. And here in this example, so I said start from a weekly, that's going to be your high time frame. The daily is going to be your medium time frame, and the 1 hour is going to be your smaller time frame. And all you have to do here is to find the overall trend on the higher time frame, your key support or resistance zone mainly on the higher time frame and medium time frame, and find a possible entry idea on the smaller time frame. So if you can actually do that and practice that, that will help you internalize the top-down analysis process. You make sure to actually try it, make sure to actually use different things. In the future, I might make another deep dive or top-down analysis where we talk about a different time frame and how to use them as well. But this one here, you make sure to understand the process first, because that's why it's really important. Now let's recap. When we talk about top-down analysis, it's all about starting big and end small. So always start with the higher time frame, weekly or daily, for example, before dropping down to lower time frame. On the higher time frame, identify the trend. Know if the market is moving up, down, or sideways. Those are the three different trends you can have in the market. Then mark your zone. Support or resistance from a higher time frame are the most important ones. So you definitely want to have that in your chart. And after marking your key zone or key levels, make sure to zoom in for entries. You can use the lower time frame, either the 4 hour or the 1 hour, to refine your setup, and even use the 15-minute or 5-minute to time your exact entry. And you have to make sure you stay aligned with the bigger picture. Only take trades in the direction of the bigger picture trend. Do your best to avoid mistake. Don't skip straight to small chart or in your major levels. Don't go straight to the 5-minute and just trade, or don't actually go bullish when you clearly see the price action on the higher time frame is coming near resistance. Don't do that. So the key takeaway here, zoom out first to give you clarity, confidence, and high probability trade. So I want to actually have an example here. So here I am BA, so I'm going to use top-down analysis. So what I'm going to do here, let's say I'm trying to find a swing trade, for example. So what I will do here, again, we have to remember what we use. We have to use the high time frame for our top-down analysis. Let's actually start it over. So we have to use the high time frame, the medium time frame, and the smaller time frame for how top-down analysis. So for my higher time frame here, I'm going to use the weekly time frame, and for my medium time frame, I'm going to use the daily time frame, and for my small time frame, I'm either going to use the 4 hour or the 1 hour, and that's where I'm going to find my entry. So let's get into it. So on the weekly time frame, when I'm looking here, I'm looking to actually look at the trend. So here I'm looking at the weekly time frame here, and you can see that we put my trend into the downside. I'm going to take a trade around this area. You want to trade an example, it's the price action already happened. So I want to show you guys about what I would have done as we actually go back in time and how would I use it. All right. So again, this is not a strategy session. It's just a top-down process example. So again, on the weekly time frame, I'm pretty much gonna find the trend. And here the trend is pretty much trending down. So immediately what I want to see on the immediate time frame is to actually have the same structure that match a bearish trend, which is something like this. We pretty much making lower highs and lower lows. So here what I will do here, I will be going to, let's actually clear this really quick. Let's go to the daily time frame really quick. So right here, if you look at the daily time frame, that's how we see we definitely have a bearish structure. Right, we're pretty much making lower low, lower high, lower low, lower high, lower low, lower high, going to the downside, right? So those right here are lower low, lower lows, and lower highs, lower highs, lower highs, lower highs, lower highs. All right, we're pretty much going to the downside. What do we have? So the trend, we have a bearish trend, which is bearish, or going to the downside. We also have this structure that also match the bearish trend, so that's good. So now what we need to do, again, we have to actually mark our key level of support or resistance on the higher time frame. So I didn't do that earlier. So I'm going to go first, make on the weekly time frame and mark the level I'm trying to trade on. So for this example, the key resistance I'm watching here is going to be here. Right? That's the level I'm watching here. So I can actually mark multiple level. I have a level at this level and one here as well. Right? So just to have a couple of level here to actually watch. So here, and the main level I'm watching is the 232 at resistance, and that's on my game plan. Is the key resistance level I'm trying to actually find an entry in here at, and that's the key level I'm watching. So now here, what I can after making on the weekly time frame, I'm going to go to the daily time frame to see if those levels are still valid on the daily time frame, and also if I can find some extra sneaky levels on that medium time frame, which is the daily time frame. So let's go to the daily time frame. So here I can see my 232 level is pretty much a nice resistance here as well on the daily time frame. So I don't need to actually make a new level as well. So the new level I can actually add from the daily time frame is going to be the 206 level. 206 level. That's a key sneaky level from the daily time frame here. That's something I can add because it's a nice simple level here. So for this example, after identifying the trend on the high time frame is bearish, seeing on the daily time frame the structure is also bearish, I also have my zone here. So after I have my zone, all I'm trying to do in this whole price action here, I'm only going to be focusing on trade that go to the downside and also near key resistance level, right? So here, my main key level that I had first was a 232. So here, this level, this area here will always be a good area of entry for me on my lower time frame. So here on the lower time frame here, I'm going to go on the, let's use the 4 hour for example, and in the 4 hour, I can actually find an entry since we pretty much trying to catch a move that match the higher trend, which is the bearish trend. And I'm only going to be trading around the 232. So all I'm looking to see is to have the price come down near that level and see if that resistance level acting the way it's supposed to act, which is act at resistance, meaning the sellers will be more active here and we can have a rejection. So here we can see the price move here or here. And this right here, we have the first candle where we actually fell to the break. And this right here show me, okay, this is a rejection. So after that, I can actually find the exact entry I'm looking for. So in this example, I'll probably take the entry at the low right here on that candle and I'll probably make money to the downside. And same thing here too as well. So what do I see here? See here we came down here and the seller again show up as resistance, showing that okay, it's rejecting. So how do I know it's rejecting? We pretty much broke that level above 222 and we actually came back right here. So here this is the rejection candle on that 232 key level. So here I have my confirmation rejection. So now I want to actually find an entry to be part of the move to the downside. And again, you can actually have different type of entry. Again, I'm not going deep in strategy here, just the process of it. So here, for example, for me, as long as it stay below 232, I could have entered on this candle or any candle over here and catch the move to the downside. So I put it simple, and you can see here the trade I'm taking is matching the bearish sentiment on the upside. Right? It doesn't mean you're gonna make money to the upside, or as a beginner, it's gonna be the easiest thing to do is to trade with the trend, right? Because catching those bounds right here, you have to be really good at your entry and exit and be good at timing. Man, here is at the beginner level, you want to actually trade with the trend. It doesn't mean you're gonna make money trading against the trend. You can see obviously the stock went up, while here you can make money with gold. The more focus you make your trading, the more simpler it is as a beginner, the more high win rate you're gonna have and the better you're going to do. Right? So this is a simple process. Let me know if you have any question and we're gonna talk about it.